Given the time of year and the prospect that a number of big US money managers have taken an extended break this week, and with S&P 500 implied volatility, i.e. the VIX, now back below 10%, one can say that the leads we have for Asia today are about as upbeat for risk appetite as one will see. One positivity reigns: financial conditions have become more accommodative, and of course this just compounds on the notion that the Federal Reserve is not only looking to hike in December, now a 97% implied probability, but the pricing in the Fed funds future through to end -2018 and 2019 also looks too pessimistic and throws weight to calls from JP Morgan and Goldman Sachs that the Fed will hike 4 times in 2018. So, we look around the markets and see the USD index lower by 0.2%, we can see high yield and investment grade credit spreads coming in 3 and 1 basis points respectively, and as mentioned, implied volatility in the S&P 500 has dropped below 10%, with the S&P 500 gaining 0.7% and momentarily breaking 2600. It must be said that volumes, predictably, have been on the light side and some 11% below the 30-day average. We can also see the Dow Transport Index and Russell 2000 Index gaining 0.8% respectively. Half glass empty. Perhaps two aspects that dampen the mood somewhat have been the 3 BP rise in real, or inflation-adjusted, US 5-year Treasury yields, and at 31 BP we can see this now at the highest level since January 2016. The eyes of the fixed income world, however, is on the yield curve though, and the pickup in social media interest on the rampant flattening of the 2S vs 5S or 5S vs 30S Treasury curve has many divided on what the market is truly saying about future growth and inflation in the US economy. 3 Treasury curve. The fact we have seen such aggressive selling in the front end of the Treasury curve is obviously the driver here, and we do question how much more upside there is, specifically in 2-year Treasuries, which at 1.77% are the highest levels since 2008 and coincidentally are now higher than Australia's 2-year government bond yields, the first time since December 2000. Taking the 2V10S Treasury curve in isolation, more rational thinkers have seen this as a sign of strong growth in the US and global economy, but of course the bigger concern is whether there is a breaking point for broader risk sentiment, as an inverted curve, i.e. the 2-year Treasury commands a higher yield than that of 10-year Treasuries, has front-run each recession in the US economy over the past 50 years. Source: Boa/Mill. The 2/10s spread is 3 BP lower on the day at 58 BP. 4 Emerging markets shining. Emerging markets are flying, and this is where traders are really generating outperformance. Asia, in particular, is looking super strong, with the Hang Seng, H shares and CSI 300 all on fire yesterday and on sizable volumes too. The Hang Seng is up 35.5% year to date, 40.7% on a total return basis, and remains the poster child of trend and momentum, which will naturally happen when T-set with its 12.5% weighting on the index has rallied 126% year to date. There is a genuine chase for performance from active money managers here, and looking at the ASHR ETF, CSI 300 ETF, and EEM ETF, Emerging Market ETF, which are trading up 2.9% and 1.4% respectively on the NYSE, and one can sense that it should be another upbeat open for Asia, and any pullbacks through this week will be supported